Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome to Metcalf Money Moment, the podcast. My name is Jeb Graham, here with Eric Wymore and Ethan Hutchison, co-hosts. How you guys doing today?
Doing really well. Thanks. Glad to be here.
It's Friday and the weather's okay for now.
There you go. Yeah,
The
it's
afternoon
been pretty
breeze.
hot here recently, but it is always nice to do these on Fridays because it's like, we get done with this and we're off to the weekend having fun, right?
Absolutely.
right.
So, well, I will say that this is the first podcast that before we recorded it, we already had the name of the podcast, which we're pretty excited about. So the title of this podcast is Executive Edge, Understanding Elite Employee Benefits. And it's something that we're pretty excited to talk about. And so we have a lot of corporate executive clients. And I think today what we really want to focus on is, when you think about a corporate executive or a highly compensated employee, at a big firm, they have their salary, they have their bonus, but so much of what their compensation package is are a lot of the benefits that are afforded to these corporate executives. And so today, I think what we really want to do is focus in on some of those and maybe talk about just some of the ins and outs of some of them. But to give you a few just kind of statistics is that in 2023, nearly 70% of all Fortune 500 companies had a deferred compensation plan for their executives to participate in. And then 80% of publicly traded companies offer some sort of stock-based compensation to their, or RSUs or stock options to their executive team. And then a lot of times, executive benefits can account for up to 40% of more of an executive's total compensation package. So bottom line is the benefits that you get from a large company as an executive or as a highly compensated employee can really be a big part of your compensation package. And it's very important to kind of understand what those are and how they work. So a few of those that we're going to go over today. So Eric in a minute here is going to talk about executive deferred compensation. And then we're going to talk about ESOP plans. So this isn't necessarily for a big publicly traded company, but there's a lot of privately held companies that become ESOPs, and Ethan's going to kind of explain some of the ins and outs of that. And then I'm going to talk about stock options, RSUs, employee stock purchase plans, and then we're going to go through 401ks, pensions, and HSAs, which are all benefits that executives have. But let's get right into it, talking about deferred compensation.
Yeah, absolutely. Thanks again. So what a deferred compensation plan is exactly what it is, or what it says it is. You are taking a portion of your compensation, of your salary, and you are deferring it to be paid to you in the future. So before we get kind of in the nitty gritty, let's kind of picture out an individual, a person that's been at a corporate America, has gone up the corporate ladder, and now all of a sudden there may be some kind of higher level executive and their salary is $1 million a year, right? So out of that $1 million, they're going to make their 401k contributions. The company is going to make their matches. They're also going to obviously take the rest of that in a salary. Well, maybe because of some kind of a strategy or tax strategy, that individual is saying, you know what, I don't need that entire amount this year. I want to have some of that paid out to me in the future years. So each plan is a little bit different, has a little bit different mechanics behind it. But for this example, let's say that this individual wants to defer $200,000 of their salary for future payment. So that person will probably set that aside or set up that part of the plan sometime in the fourth quarter of the prior year. And then when the salary starts getting paid out in the current year, a portion of that's going to be set aside and go into their and be part of their 401k or in that employer retirement plan. The cool thing about that is they can actually invest it a lot of times. There might be some parameters on what they can invest in, but they might be able to invest it in some kind of a target date fund for when they want to draw it out. The other unique thing is you set up when you want the funds to start paying you back. So, for example, you might say, I would like 5 years after I separate from service for this particular deferral or deferred comp to start paying me out. So, or you might do it 3 years, or you might do it 10 years. It all kind of depends on your current situation. But I think for practical purposes, the reason you would do this is because you might have a gap or a period of time when you are ending your career, retiring, and maybe you want to retire at 55, let's say, and you want to have your deferred comp start paying you at 56, 57, 58, 59 years old, and so on. So one of the reasons that you want to do a deferred comp plan is to defer the tax bill, right? So if you're at a high tax bracket making $1 million a year salary, all of a sudden you're going to retire at 55 when you have very little income. Maybe you retire to a low income state like Texas or Florida. Now all of a sudden, as you're drawing out that you're starting to make that payment on that deferred comp plan, you're in a lower tax bracket, and it's a successful way to defer those taxes. Some of the things to consider before you sign up for a deferred comp plan is that is an asset that sits on the balance sheet of that business, right? So if that business goes through some financial struggles, it is an asset. It is considered an asset on that business versus your 401k is your 401k and is not an asset of the business. Yeah. So it's obviously a plan that you want to consider, certainly as you're climbing the corporate ladder, certainly a benefit that you want to take advantage of amongst others.
Yeah, and those are typically going to be highly compensated employees and executives that have access to those plans. And I'd say even like the example that you just gave, like, so somebody that's making $1 million a year, they're in the top tax bracket, right? So they're paying 35+% taxes. So let's say like in that example you give, so they saved $200,000 into their deferred comp plan. Well, they just saved $70-some thousand in taxes, federal taxes that year, right? And then they retire at age 55. And now they start taking out $200,000 a year, and that's their only income, right? Mm-hmm. So now they're in the 22% tax bracket. So on that bucket of money, they just literally saved about a 15% in taxes, right? And that can be a really huge benefit, especially for those people, like you said, that want to retire early. I think it can be huge. So I don't know, Ethan, when we were talking about, we had a couple clients in a week or two ago that were part of some organizations around town that had those ESOP, employee stock ownership plans, which are unique as well and such a wealth builder for so many people.
Yeah. These are my favorite. I'll admit it. I love ESOPs. I think they're super cool. The way that they work and just the way that wealth is accumulated over time inside of these ESOPs is fascinating to me. We work with clients all across the Kansas City Metro and across the United States. Some of the main ones we work with, you're going to see a lot of engineering firms, Burns & McDonnell, Black & Veatch, construction from McCown & Gordon, J.E. Dunn, Shamrock Trading has a big one, Amstead Rail. There's a lot of companies local that have these, so it's really, really fun when we get to look at them. And a lot of the times you realize that you have an ESOP, but it's a defined benefit plan. It's not a defined contribution plan. So you're not physically taking your cash flow and putting money into these plans. Your company, your privately held company, is issuing you shares that vest over time inside of this ESOP. So employee stock ownership plans, it is kind of exactly how it sounds. Similar to Eric's deferred comp, they don't really try to hide anything behind the name, but employee stock ownership plans are given to employees of employee-owned companies. So they might start from a succession plan conversation where a business owner might hypothetically have, a large capital gain inside of this business. They want to sell and retire. How do they do that tax efficiently? They can sell that company back to the employees and then kind of defer capital gains taxes and things of that nature for the business owner along the way. They're very unique in the fact that they provide very, very good retention benefits to employees as well. So if you have an ESOP plan and you've been there for 5 years, let's say the ESOP's $250,000. Then you're there for 10 years, that ESOP's, north of $1 million. And then you get to the 20 and 30 year employees that are there, and they might have a $600,000 401k, and they have a $5 million ESOP that is kind of parked alongside that 401k plan. It's kind of like they blink and now they're worth $5 million because they've been so entrenched in their work from day to day that over time that ESOP just continues to grow. They're insanely efficient as far as growing those, although we have seen, and Jeb, we were talking about this yesterday, one of the common ones we work with, we saw a little dip in their ESOP. So you're not always going to be making money in these things. They're kind of dependent on the profitability and the growth of the organization. So it's really nice because you're a stakeholder alongside with all your other employees, and you want these things to grow. Mm-hmm. How do these work in retirement? So they're qualified accounts. So when you do retire, or let's say you move companies, you go elsewhere, you are entitled to your vested portion of your ESOP balance. It's a qualified account, so it would roll over into an IRA or some sort of pre-tax qualified account as well. So there's not really very good tax benefits to them, other than you're accumulating a lot of wealth very quickly inside of a lot of these ESOP plans.
And it defers those taxes, I guess, would be the benefit. And so to define what a qualified plan is, so that would just mean that basically it's coming out pre-tax. Anything you're given is pre-tax, gross tax deferred, but then you got to pay the taxes on it when you take it out. And that's, we haven't seen any Roth ESOPs yet, but maybe someday that'll happen, huh?
Yeah.
That'd
be awesome. Yeah.
That'd be a pretty sweet deal, wouldn't it?
Yeah. That'd be great. But even then, we see folks, retiring at age 50, and they might have $5 million in an ESOP and $500,000 in a 401k. Keep in mind, that's all pre-tax. Right. There's some cool things you can do, like the Rule 72T, if you want to retire at 50 and start drawing. We've talked about that before on the podcast. So even though it might look really glaring at the end of the day, this large tax you're going to have to pay over time, if you can set that up, at 72T and really draw that out over time, it's simply just like a 401k.
It's a good problem to have, right? It's one of those where, and it really is amazing, some of these companies that have ESOPs around town. Like, you've got a couple of companies that have what you would consider like rank and file employees, right? That make a good living, but they're not high earners by any means, that end up with millions of dollars in these things. And it's just such a cool benefit. And so anyway, it's neat to see, and they're great clients for us to work with, because there's a ton of good things that we can do for those people as they retire, as they exit the company, and try to figure out what to do with those dollars. So,
and the ESOPs are all for privately held companies, correct? Right? So you're not going to get an ESOP at Oracle or stuff that. But public companies have other things like stock options and RSUs. So Jeb, why don't you talk to us about those?
Yeah. So that was where, to Ethan's point, where you've got privately held companies that have ESOPs. We talk about executives that work for, and this isn't necessarily just executives. There's a lot of publicly traded companies that have stock benefits for employees at all levels, right? But when you really think about the executive benefits and high earner benefits, well, I would say in general, from stock plans at publicly traded companies, there's really three main ones, right? You've got restricted stock units, which we see a lot. You have stock options, which we see some, but not quite as much as restricted stock units. And then you have what's called an employee stock purchase plan in a publicly traded company. So big difference between all three of those. And I think the one that we really want to focus on the difference of is going to be the restricted stock units and the stock options, because those are two very different plans. But I think people get those two confused sometimes. And if you're going to do like a quick analogy of the two, if you think of an RSU, you can think of that as a gift of shares from a company once you actually earn them, okay? And when you think about stock options, think about a coupon to buy shares at a set price in the future, okay? So let's talk about these restricted stock units. And we get these a lot. We're a company, let's just say you work for XYZ Corporation, and at the end of the year, they say, hey, we're going to give you a bonus of restricted stock units. So maybe it's going to be $20,000 of restricted stock units. So you get that $20,000 granted to you, and they might vest. And I say the typical vesting schedule we see with restricted stock units is going to be 3 years. So basically you get it, you kind of have ownership in that stock, but you don't actually own that stock until it vests 3 years from then. And then the year that it vests, you're on the hook because it's a gift and it's basically income. You have to pay ordinary income tax on the value of those restricted stock units. So, but it's a great benefit because you actually own the stock in a restricted stock unit. And then basically you can hold it as long as you want. So when you get the stock, you can hold it for one day or you can hold it for 20 years. And then basically whenever you sell it, you have to pay the capital gain on the difference between the day, the value that you were gifted it at and what you sell it at. So that's a restricted stock unit. And then when you're talking about stock options, it works kind of similarly because they grant it to you at a certain time, but then a lot of times it could be 3 years later, 5 years later. They have so when they grant it to you, that's at the strike price. Okay. So let's just say it's $20 a share today. You get that. That's the strike price. And then you have a time period when you can exercise it. So let's say it's 3 years from now, you can then exercise it, and they give you a 3-year window to exercise it. So basically somewhere between year 3 and year 6, you need to exercise that. So again, back to that example, it was worth $20 of the strike price. And let's say 5 years later, that same stock is worth $40. Well, now you have basically a gain of, when you exercise that, you make the $20 of gain on that stock. So that too is going to be ordinary income in the year that you do that, because that is income. You can then hold that stock as well and then sell it later, after you've exercised it down the road. So stock options, RSUs are going to be a little bit different, but they're both great benefits. And then here's the next one, which is the employee stock purchase plan. This is the one that I would say is typically available for almost everybody in the company if you want to participate in it. But think about, like, in an employee stock purchase plan, think about your 401k, where you just set up a percentage of your salary that you're going to put aside every paycheck, and you're going to buy into your 401k. Well, same thing in an employee stock purchase plan. The difference is it's not pre-tax. So you're putting in post-tax dollars. And typically what you're doing is you're buying shares of stock, and you're buying them at a discount. So let's just say it's $100 for XYZ stock. You're purchasing that every 2 weeks. Well, you might be buying that $100 share of stock at $85 or 15% discount. And then typically you have to hold that for a certain amount of time, which a lot of times call it 6 months or something like that. And then you can sell it. So if you sell it, you've made an instant 15% profit, right? Because you got to buy that at a discount. So I would say the thing to be wary of all these plans, restricted stock units, stock options, employee stock purchase plan, is you have to be very careful, especially if you're a highly compensated executive, not to get too concentrated in that stock. And we've run into that many times, where we have somebody that's worked at the same company for a long time. They've had all these stock benefits, and then all of a sudden they wake up one day and 60 or 70% of their money is in that company stock. And so now they've got this big risk if that stock does poorly. And they also do amazing if the stock does great, by the way. So there can be positive sides to that, but I think the school of financial planning would say you don't want to put all your eggs in one basket. You want to make sure to diversify that stock over time. But those are great benefits, that you can get. And then, I think that the next thing that we were really wanting to talk about was some of the more common benefits that are available to all employees, right? Such as 401ks, pensions, HSAs, and stuff like that. So
Yeah,
let's talk a little bit about 401ks. Absolutely.
This is the bread and butter, right? This is how everybody gets to start saving for retirement, and that's in their 401k. And I'm going to go over a little bit on the limits of 401k. So if you're under 50 years old, you can put away deferred $23,500 in the year 2025. If you're 50 years or older, you can add an additional $7,500. There's also a super catch-up clause. We're not going to get into that one here today. We've talked about it on previous podcasts, but keep it kind of high level today. So if you're over 50 years old or older, you can put away $31,000 into your 401k as a contribution. There's also, if you're over 50 years old, you actually can put away $77,500 total in there in an after-tax situation. So let me break that down for you. You're able to put $31,000 of your own money in, then the company match, then you're actually able to do some kind of an after-tax situation contribution into your 401k plan, as long as that total amount is less than $77,500 if you're 50 years old. Why would you want to consider doing an after-tax contribution into your 401k? Well, with a lot of major corporations, they allow you to do an after-tax contribution into that 401k, and then immediately you can convert it to a Roth. A lot of plans will call this some kind of a mega backdoor Roth plan. So again,
And
let me
that's
run
where
that.
we have, that's where we have confetti that blows up in the background. The
Exactly.
mega backdoor.
It's mega.
Exactly.
Yeah.
So again, if you make $300,000 or so a year, and you're contributing, you can contribute $31,000 if you're over 50. Say the company match is $12,000. Well, that total number is $43,000 that you're putting into your 401k. The max is $77,500, and that allows you to put another $34,500 into an after-tax portion of your 401k plan. Call up, if you're with Fidelity, you call up Fidelity and say, hey, as soon as this hits the plan, my after-tax contribution, I want you to convert it to a Roth and put it in the Roth part of the 401k. Now, all of a sudden, you are literally contributing $30-some thousand into a Roth IRA each year. Obviously, you got to pay the tax on it when you get the income, because of the income. It's earned income when you earn it from your salary, but then that money will go tax-free, and you're able to withdraw it tax-free when you're 59 and a half or into retirement. It's a phenomenal situation that most individuals that work at a large corporation have access to, and they absolutely need to take a look if they're able to.
I agree. Those are those mega backdoor Roths. When you think about putting that much money into a Roth IRA over time, and I know just based on using our e-money and our financial planning software, especially if you're younger, but I would say even in your 40s and 50s, when we run that plan of them putting that in a Roth versus a traditional, even high earners, a lot of times the plan looks so much better with the Roth, just because even if you're 50, the chances are you're going to live till you're 90, right? And so that's 40 years of that thing growing tax-free. And it's just the compounding. I think people underestimate the power of that over time and not ever having to pay taxes on that, let alone when your kids inherit it, or whoever it is that's going to inherits it on a tax-free basis.
Absolutely. And again, it does take an extra step. We've walked many clients through it, and be more than happy to walk anyone else through it.
Yep. So what Eric was just talking about is a defined contribution plan. That's 401k, right? There's also defined benefit plan. Everyone's heard of the old pension plan or the defined benefit pension plan. And I actually saw a statistic that says, while only 4% of private sector employees have a defined benefit pension plan anymore, that number is significantly higher among senior leadership teams, because there's things that are called executive supplemental retirement plans, or SERPs, right? So there are still these pensions out there, but the old school way was companies used to basically, you didn't have a 401k, didn't have a defined or contribution plan. What they would do is they'd put money away in a pension plan, and then once you retired, you basically got a salary for the rest of your life based on that pension plan. And over the years in the private sector, that's kind of faded away for your average employee. There's just not that many of them out there anymore. But what we will say is for executives, they have those big CERT plans. And then in the public employees, when you're talking about public school teachers, people that work for any government municipality, the federal government, well, pension plans are still very prevalent there. And they're a huge part of people's retirement. And by the way, they're clients that we love to work with, right? Because when you have somebody that retires with a pension, a lot of times they don't even need to use a lot of the money that they've saved in retirement plans. But what I will say is, if you've got a pension, so say you're a public employee, or if you're, an executive that has a CERT plan, or if you're one of those 4% of people, I was actually just talking to a client yesterday that works for Johnson & Johnson. They still have a pension plan. He's a salesperson. They still have a pension plan. We went over it, and I'm like, man, that's a really good deal because he's got a 401k and he's got a pension plan. But if you're one of those people that is fortunate enough to have a pension plan, it's important to realize that when you get ready to take that pension in the future, there's a lot of options on those pensions, and it's really important, in my opinion, to meet with a financial advisor to go through them, because a lot of them have lump sum options. Where basically you can take either all or a portion of your benefit in a lump sum and roll it to an IRA to take ownership of those dollars and to get control over them. And then you also go down the road of having what they call joint and survivor benefits. So say you're a married couple. Well, if you take the single life benefit on a pension, that means if you die 4 years later, your spouse is left high and dry without anything, right? Because you just only took the highest level benefit for yourself. Whereas they also have what are called joint and survivor benefits. So if you have, you might be able to take, if your pension was $5,000 a month, you might be able to take $4,000 a month, and that actually survives both you and your spouse. Meaning if you die 3 years in, your spouse still gets that benefit for the rest of your life. So I guess the bottom line there is if you do have a pension, congratulations, because not a ton of people do, and it's an awesome benefit to have. But when you do get ready to take that pension, it's really important to meet with a professional, go through all the options, and make sure that you know what you're doing there. So
last one I have is going to be the health savings accounts. So HSAs. Jeb said something earlier. I think Eric also said, there's some of these things we're talking about that are available to, highly compensated individuals. And then some of these are kind of just run-of-the-mill employee benefits that a lot of companies have, but not everyone might take advantage of. And a health savings account is one of them. And I'm going to throw confetti in the background after I say this, but they're triple tax exempt.
Boom.
Boom. So you're going to have, you put the money in, it's the contributions are tax deductible. When the money grows inside of that HSA, if you invest it, it grows tax deferred. And then when you pull that money out for qualified medical expenses, like a doctor's visit, or you can even get laser surgery on your eyes, and you can use your HSA for that now. So those qualified medical expenses, you don't pay taxes when you pull the money out of there. How do you become eligible? You've got to be enrolled in a high deductible health plan. You cannot be on Medicare. You cannot be claimed as a dependent on someone else's tax returns, and you cannot be covered by a high deductible health plan. I got to look up the limits. I'm going to run off my cheat sheet here because they change every single year. So an individual can put up to $4,300 into their HSA, and a family can put up to $8,550, so $8,550 in your HSA. A lot of companies also will contribute as well. I know there's a ton of companies in the KC area that on January 1st, as part of the employee benefit, if you're enrolled in an HSA, that company will put $1,000 inside your HSA on January 1st. So if you're not taking advantage of that, that's a free $1,000 that you could definitely be taking advantage of. So those are unique. The best part about them, I know with the FSA, if you don't use it, you lose it. Well, with an HSA, it's portable and it rolls over into the next year. But also, if you leave a company that you're at and you have dollars in that HSA, that can come with you as well. So that company doesn't own the HSA, it's your account that you own. A lot of times we see people fund these things very aggressively, and then they deplete them at the end of the year very aggressively as well. So what we encourage people to do is if you're going to fund these things and you want these to start growing, invest the dollars that you put in there. Maybe leave $500 in cash so you can swipe your HSA debit card. But if you're going to Walgreens to buy Advil or Robitussin for your sick, toddler, don't use your HSA. Pay for that out of pocket. Let that HSA grow. And then later in life, when you need it for surgeries or MRIs or things of that nature, you can pull funds out of that HSA tax-free and use those. Don't nickel and dime yourself over time by using it for small prescriptions. A small little nuance that I've heard before, people don't want to put money into an HSA because they're like, well, when I'm in retirement, I'm going to be on Medicare. My premiums are low. Most surgeries that I need in retirement are going to be covered by Medicare, so I'm not going to use the HSA. Well, if you fund that HSA healthy over the course of your lifetime or working years, when you turn age 65 and you want to pull, let's say you have $100,000 in your HSA, you can pull money out of that for non-qualified medical expenses. You're just going to pay ordinary income tax on that distribution. So it's kind of a double-edged sword. You work you work, you save, you defer all those taxes. You don't really want to take them out and pay taxes on that, but you can. It's not, advised. We don't tell people to use an HSA as an IRA, but you don't get locked up into that thing. You can still access those dollars.
Yep. Nice. It's a great benefit to have. And the triple tax exempt, I mean, there's just not, it's the only thing out there. I remember we had a guy that used to work in our office years ago, and he would talk about that. And man, he would get so excited about triple tax exempt. And it's a pretty neat deal because I don't know too many people that love paying more taxes than they have to. And anything you can do to get that tax break is awesome. So
That's right.
Guys, this has been a super informative. And I tell you what, if you're an individual out there, an executive that has questions on your benefits plan, we would love to visit with you. And I think this has been super productive half hour. And this is Metcalf Money Moment podcast signing off.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.